In this lesson, we continue with the forms of ownership. So we have already done the first two, which is the sole trader and the partnership. So today we are focusing on the closed corporations. A closed corporation consists of 1 to 10 owners who are called members. And the abbreviation for closed corporation is CC. A CC must be registered with the government. The characteristics of the closed corporation are: a closed corporation consists of 1 to 10 members. The name of the business must end with CC. And a founding statement must be completed to register the CC. A CC must appoint an accounting officer to prepare financial statement. Each member's interest in the business is expressed as a percentage. A closed corporation has existence continuity. In other words, if a member dies or retires, the CC still exists. Profits are paid out to members in the form of dividends. Members have limited liability for the deaths of their business. A closed corporation may not have an interest in another closed corporation. And what are the advantages of the closed corporation? It is relatively easy and inexpensive to establish a closed corporation. Financial statements don't need to be audited. A closed corporation has existence continuity. Members have limited liability. Members can combine ideas and skills to the advantage of the CC. And what are the disadvantages of the closed corporation? A closed corporation must have an accounting officer. Since the membership is limited to 10, capital contributions are also limited. The decision-making process may be delayed if the members disagree about something, and a closed corporation has more legal requirements than a sole trader or a partnership. And we have the statement here that says that since the implementation of the New Companies Act, which is Act 71 of 2008, no new closed corporation may be registered. However, closed corporations that existed prior to the implementation of the new act are still valid. Existing closed corporation may also be converted into companies. So which means today you cannot register a closed company. Okay. Only the company that registered before this act of 2008 come into effect. Okay. And then the fourth form of ownership is private companies. Okay. A private company is a large company owned by private owners, known as shareholders. Shares in a private company are not available to the public. What are the characteristics of a private company? The name of the private company must end with the words Proprietary Limited or Pty Ltd. You know that Pty stands for proprietary and Ltd stands for limited. So the company must end with Pty Ltd. And you know that it is a private company. According to the current Companies Act, Act 71 of 2008, a private company must have at least one shareholder and is no longer limited to 50 shareholders. A private company has at least one director. Shareholders have limited liability. Directors have personal liability. A private company is regarded as a separate legal entity and pay taxes on all profits, which is a company tax. Okay, let me scroll up a bit. This is page 122 of your textbook. A private company has existence continuity. In other words, if a shareholder die or retire, the business continues uninterrupted. A private company cannot be listed on the stock exchange. A private company must be registered with the Companies and Intellectual Property Commission, which is the CIPS or CIPC. Okay, so you must know that CIPC stands for Companies and Intellectual Property Commission. Okay, so that is a private company. The advantages of the private company: greater capital contribution, as many shareholders can provide capital. A private company is a separate legal entity. Shareholders have limited liability. A private company has existence continuity. Directors are protected by Companies Act. And the disadvantages of a private company: more difficult and expensive to establish than the other forms of ownership. Subject to many legal requirements, financial statements must be audited. Shares cannot be sold without the consent of the other shareholders. Shares cannot be offered to the public. A private company cannot be listed on the stock exchange. And we go to the fifth form of ownership, which is the public companies. A public company is a company whose shares are traded on the stock exchange. Anyone may purchase and sell shares in the business. The characteristics of a public company: the name of a public company must end with Ltd, which is limited, just Ltd. A public company has at least 3 directors. There is no limit on the number of shareholders. The public is invited to buy shares in the company. The document that provides the information about the company's shares before being offered for sale to potential investors or shareholders is called the prospectus. This is one of the definitions at the top. Shareholders have limited liability. A public company is regarded as a separate legal entity and pays taxes on all profits, which is company tax. A private company has existence continuity, except in the case of liquidation, where they don't have money. In other words, if shareholders die or retire, the business continues uninterrupted. Shareholders pay taxes on dividends they receive. A public company must be registered with the CIPC, which is the Companies and Intellectual Property Commission. Advantages of a public company: capital contribution is unlimited, as there is no limit on the number of shareholders. A public company is a separate legal entity. Shareholders have limited liability. A public company has existence continuity. Shares may be freely bought or sold. Disadvantages of a public company: an accounting officer must be appointed, expensive to establish, subject to many legal requirements, financial statement must be audited, all information must be made available to the public, which may help competitors. Managing the business may be complicated due to the large size of public companies tend to have. That brings us to the end of the 5 forms of ownership. The first one is sole trader, second one is partnership, third one is closed corporation, fourth one is private company, and fifth one is public company. Now you do the same as we did with the first 2. You study these 3, you know the definition for each, you know the 3 characteristics for each, you know 3 advantages for each, and you know 3 disadvantages for each. Okay, and after that you do this activity 18.2, where you need to answer these questions. You copy the table to your book and you answer the questions. Okay. Okay, before you go and do that, there's a table for tips in page 125. Table for tips in page 125. They say the table below will help you to study for test and examination. It gives a short summary of the different forms of ownership. Use this table to make comparison between the different forms of ownership. Okay, so we have a sole trader, we have partnership, we have close corporation, we have a private company, and we have a public company. And how do we differentiate? We differentiate by the number of members, we differentiate by the liability, we differentiate by who owns the business, the tax, the profit distribution, and who manages it. So sole trader is owned by one person, liability is unlimited, and it is owned by the owner, and the owner pays the personal income tax, and the owner takes all the profit, and the business is managed by the owner. We go to partnership. It has got two members, liabilities unlimited, the business is owned by the two partners, and when it comes to tax, both the partners pay the personal income tax, and the profit is divided as per the partnership agreement, and two or more partners will manage the business. We go to close corporation. It has got 1 to 10 members. Liability is limited, and the business is owned by members, and the business pays company's tax, and profit is paid to each member according to their interest expressed as a percentage in the business, and all or some of the members manages the business. We go to private company. Members, no limitation, it can be any number, and liability is limited, and the business is owned by shareholders, and the business pays a company's tax and dividends per share depending on the number of shares. This is the profit distribution, and the business is managed by one or more of the directors. And we go to the public company, no limitation to members, liability is limited, and the business is owned by share members, and the public company pays the company's tax and the profit distribution, dividends per share depending on the number of shares. And who manages the business? 3 or more directors. So this is how this table, you can use it to differentiate between sole trader, partnership, close corporation, private company, and public company. But when you differentiate, it is important to describe this. Is it 7 items? 6 items each. Okay, you must say something about members, you must say something about the liability, you must say something about the ownership, you must say something about the tax, you must say something about the profit distribution, and who manages the business. So please study this table as well. It will help you to study for test and examination, and as we practice, I'm going to expect you to know how to do this. Okay, all the best.